Good morning. As Allison said, my name is Joan Koonce, and I am a professor and financial planning specialist at the University of Georgia. And I work with Cooperative Extension. Next slide, please. I'm going to be talking to you all today about some tax and other federal stimulus benefits that have been provided because of the COVID-19 pandemic. And so I wanted to start by talking about some basic things that were offered through the Department of Treasury, the IRS, and also the State Department of Revenue. Many of you may already know the 2019 federal income tax filing and payment deadline was extended from April the 15th to July the 15th. Originally, the IRS and the Treasury Department had just extended the filing deadline, but not the payment deadline. But then because the pandemic was so bad, they decided to do both. As a result, some states decided to follow suit, and the Georgia Department of Revenue here in Georgia, of course, they decided to also extend the 2019 state income tax filing and payment deadline as well from April 15th to July the 15th. Next slide, please. I don't know if all of you know, but before the CARES Act was passed, the FFCRA Act was passed, which is the Families First Coronavirus Response Act. And it was actually passed probably about a couple of weeks before the CARES Act. And there were many provisions as part of this act, but the one that I wanted to talk about that actually has impacted individuals, probably some of you all maybe have impacted some of you all of your families, is the changes that have been made with health plans. As part of the Families First Coronavirus Response Act, all private comprehensive health plans are required to provide health care for diagnosis and treatment of any COVID-19 related illness with no out-of-pocket costs, which means that if you were to see a doctor for those for COVID-19, then you would not have any deductible co-payments or co-insurance. Also, they made a change to those people who are part of high deductible health plans and require that no deductible or a deductible that is actually below what the minimum annual deductible normally is, it would actually be less than that now because of COVID-19. And so if you went to a doctor or a hospital for diagnosis and treatment of anything related to COVID-19, then therefore you wouldn't have to worry so much about the high deductible during this period of time. One of the things that people may not realize is that even though the act does not require this, many health insurance companies have decided to not charge any out-of-pocket costs at all, just for any health care for a certain period of time. For example, I know with my comprehensive health plan at the University of Georgia, they have decided, I know until May the 31st, when I see doctors now, I only see them through telehealth because I'm one of those high risk people, so I'm trying to stay home as much as possible. But when I see those doctors, instead of me having to now pay that copay, they're actually paying the full cost of what, and I don't have to actually pay the copay. That is not something that the insurance companies have to do, but some insurance companies have decided to do it for a period of time. Next slide, please. Another thing that's important to know is that the changes that I just spoke about, those changes actually apply to both in-person and also telehealth visits, because during this period of time, a lot of people who see doctors on a regular basis, they're not able to go into the office, or the office is actually limiting the number of people that are coming in. And so as a result, if those people can actually see doctors virtually, then that's actually being supported during this period of time. Also, if you actually have a flexible spending account or a health savings account that goes with your high deductible health insurance plans, then during this pandemic, they're allowing people to purchase over-the-counter medications without a doctor's prescription. They're considered qualified expenses now. Before the pandemic, over-the-counter medications could only be covered under these accounts if you had a doctor's prescription. You know, I know sometimes people are required to take iron or calcium, and oftentimes doctors would give them a prescription even though they were out over the counter, because with the prescription they could actually be covered or paid for through these accounts. And now you don't actually have to have a prescription. Next slide, please. The next thing that I wanted to talk about is the CARES Act, which is the Coronavirus Aid, Relief, and Economic Security Act. And there are going to be about 5 things I talk about with respect to this act. One of the main ones that people are asking a lot of questions about are the economic impact payments. Those economic impact payments are really important to some people during this period of time, because some people have lost employment or they have reduced income, and so those payments have become important. To receive these payments, people are supposed to be either a United States citizen or a United States resident alien. The persons have to have a valid Social Security number, and the person cannot be claimed as a dependent of another taxpayer. Those are the requirements that's necessary. However, I'm sure if you watch the news, you've probably seen where some payments have been sent out erroneously by the IRS, and those things are supposed to be corrected. I can't really comment on any of those things, but I do know that some payments were sent to people who were not United States citizens or United States residents. So that I think they're having to work through a lot of the bugs in this program to make sure these programs work properly. Next slide. The payments that people can actually receive are $1,200 if they are a single individual or head of household, and $2,400 if they are a married couple. And these payments actually, these full payments actually go to individuals with the income up to a certain limit. For example, for a single individual, if your adjusted gross income is up to $75,000, then you can receive the full payment. If you are head of household, then your income can go up to $112,500 and still receive that full payment. If by chance that your income is higher than that, you receive a payment until it actually completely phases out. For example, for every, I think it's $5 in income above that amount, your payment is reduced by $100. It's something to that effect. And so it goes up until you reach an adjusted gross income where then you no longer would receive the payment. For those people who are married, they can receive the $2,400 payment as long as they're just for adjusted gross incomes up to $150,000. Next slide. Also, an additional payment that can go to individuals is $500 for each child that they actually care for under the age of 17. So they can receive an additional $500 for each qualifying child that they have under age 17. It's pretty much the same criteria for the child tax credit, because those children have to be under the age of 17. Also, some things that people are getting some concerns about, excuse me for a second, or how do I receive these payments, or do I have to do anything? For some people, those payments are actually automatic. So if the person actually filed a 2018 or 2019 tax return, then those payments are supposed to come automatically. Based on information I've received from people that I know, it seems like the people who filed tax returns in 2019 are the ones who started receiving those payments first. So those who filed tax returns, it seems like, based on what I've heard, is that those people are getting payments first. If the person actually receives government benefits such as Social Security or Supplemental Security Income or SSI, veterans benefits, those types of government benefits, And if they don't have to file a tax return, they're not required, then those people also receive the payments automatically. And because they already have the information on those people as well. That's why some people can receive the payment automatically and some people aren't, because if you file your tax return, then they have the information for you. If you receive government benefits, they have that information for you. So it's so much easier to get those payments out. Next slide. Some people, of course, have to request payments because unlike what some people think, there's a lot of people who can receive these payments, even homeless people. That's why the IRS is really trying to get some help to get the word out so that people can get this money because they really need it to live during this period of time. So you can request payment if you have to at the website link that I've listed here. And those people who have to request a payment are those people who did not file a 2018 or 2019 tax return because they were not required to do so. Not everyone is required to file a tax return. There's reasons why you don't have to file. You may have not met what's called the gross income filing requirement. It means your income is less than what you have to have in order to be required to file. So some people don't have to file, and as a result, they did not file. Also, you have to request the payment if you receive government benefits and you are not required to file a 2018 or 2019 tax return, but you have or you care for a qualifying child where you should receive the $500 payment. So let's say, for example, if you receive Social Security benefits, you didn't file a 2018 or 2019 tax return, and you could receive your $1,200 or $2,400 if you're a married couple automatically. But if you are, let's say, a grandparent caring for a child that's under 17, you would still have to fill out the form at the IRS's website in order to receive the $500 for the qualifying child that you care for. Another question that people are having about the economic impact payments is, will we have to pay taxes on this money next year during tax time? The answer is no, it will not be considered taxable income. As a matter of fact, the economic impact payments are actually considered a refundable tax credit. So for people who really, if they don't receive the payment, if they file taxes next year, they'll be able to still receive the payment at that period of time. Next slide, please. Okay, another benefit that was provided to people had to do with retirement accounts, individual retirement accounts, and also employer provided retirement accounts like 403Bs and 401Ks. One of the things that was provided as a benefit is that if you needed to take a withdrawal from your retirement account, that you can actually do that penalty-free during the 2020 calendar year. Normally, when you take money out of your retirement account before the age of 59 and a half, the government does that because they want to prevent you from spending the money you're setting aside for retirement. But during this year only, as of now, you can take that money out of the account without having to pay that 10% early withdrawal penalty if you are under age 59 and a half. Basically, when you take money out of your retirement plan, you still have to pay taxes on that money, and you normally have to pay taxes on that money for during the when you take it out. So during the tax year in which you take that money out. But because of the COVID-19 pandemic, they're allowing people to actually spread the tax obligation for that money, the taxes, what they would owe on that money for over 3 years. And they're also allowing them to be able to reinvest that money over a 3-year period of time if they don't want to actually pay taxes on that money. So that's a really great benefit. Also, they have changed the requirements for what's called the required minimum distributions, or some people refer to them as RMDs. Normally, when you reach a certain age and you begin to take money out of your retirement plan, up until December the 31st of 2019, when you turned 70 and a half, you actually had to start taking required minimum distributions out of your retirement accounts. That because of an act they passed last year called the Secure Act. That age has now changed to 72 starting January of this year. But what that means is that if you are retirement age and you're living in retirement, once you reach that age, whether it's 70 and a half, or if it's, um, now it's 72, once you reach that age, you have to start taking a certain amount of money out of your retirement. The amount of money that comes out of your retirement is literally based on how much money is in the account at December the 31st of the previous year and a life expectancy table that the IRS uses. And so once that amount is decided, you have to take it out the next year by December the 31st of the next year. If you're just starting, it has to be by April 1st. However, if you don't take that money out, then there is a penalty of 50% of the amount you were supposed to withdraw. But because of the COVID-19 pandemic, they have suspended required minimum distributions. So these people will not be penalized for 50% for not taking that money out this calendar year. Next slide, please. Also, one other thing I wanted to mention, there are some retirement plans that will allow you to take loans from your account. It depends on the employer. But if the actual retirement account allows you to actually take loans, then they have, the act has allowed for loans to be taken out to at an increased amount. For example, in the past, you could take out $50,000 or a certain percent of what was in the account. Now that loan limit has increased to $100,000 or 10% of what's in the account, whichever is less. And that applies to any loans from your retirement accounts that you take out on or before September the 23rd, 2020. Also, loan repayment has actually been delayed for up to 1 year. So that's 3 benefits that they have provided for retirement accounts. Next slide, please. Also, with respect to unemployment benefits, which is actually not my specialty, but I thought it was important to mention some of these things as well. I don't know all the details about some of these things, but I thought it was important that you know this basic information. The federal government has provided an additional $600 per week from us for people who qualify and are eligible for unemployment benefits. And that stays in effect until July the 31st of this year. So that's an additional $600 but it has nothing to do with your state benefits. You would receive those. They're giving an additional $600 to supplement what you would receive from the state. Also, the federal government has allowed people who exhaust their state benefits and they're still not working, they have provided them an additional 13 weeks of benefits that's funded by the federal government. So instead of the normal 26 weeks that you would receive the unemployment benefits, that can be a total of 39 weeks. Next slide, please. And also they have some stipulations where those people who were formerly not eligible for benefits, they can actually receive benefits now, like self-employed people, part-time workers, independent contractors, people that normally would not receive those benefits. They have put stipulations in where they can receive benefits now. However, I've been on some calls with some senators, and I was on a call the other night with Senator Perdue, and I know that some people are still complaining because they are not getting their unemployment benefits and they say they qualify. I can't tell them why they're not getting them, but I think with many of these benefits, I think every system is technically overwhelmed right now. And so things are not happening as fast as people would like for them to happen. So oftentimes what he was saying on the call is that sometimes you have to reapply. And so that may be the case. Next slide, please. There's also been a benefit for those people who actually have student loans. They've been automatic deferrals. For example, loan payments, both principal and interest, has been automatically suspended for 6 months up until September the 30th, and there's no penalty for that whatsoever. This applies to direct loans, including PLUS loans, Perkins loans, and Family Federal Education loan programs if they're held by the Department of Education. This does not apply to any private student loans, only those that are actually held by the Department of Education. Next slide, please. And then the last thing I wanted to mention is that it's not my area of expertise, but I thought it was important to that you all know about this. And these things, if you know people who have small businesses or self-employed people who, then it's important that they contact the Small Business Association because there are some protections that are put in place for self-employed and small business owners, those who have fewer than 50 employees. For example, there's a benefit called a Paycheck Protection Loan. And you can actually obtain these loans through any small business association lender. Businesses can actually get 2 times their average monthly payroll costs, up to $10 million. I know that there are some stipulations where these loans can actually be forgiven if certain conditions are met. This is the one that many people had lots of concerns about because they thought it was going to put, of course, the U.S. in lots of debt. But the conditions I know have to do with a certain percent of the money has to be used to pay employees so that they don't lose their job. I think it was like 80-some%. They have to be employed within a certain period of time after a certain date. The money can also be used for things like rent, interest on mortgages and utilities. But I do know that some of these loans can be forgiven if certain conditions are met. Next slide, please. And then also, there's a few other types of assistance that's been provided. They have emergency grants up to $10,000 that don't have to be repaid. There are some disaster loans, and also they're providing some relief for those people who already have loans through the Small Business Administration. Next slide. And this is the last slide, and this is actually some assistance that they're providing for businesses of any size. The federal government has decided that they will provide a refundable payroll tax credit of 50% of employees' wages up to $10,000 per employee during this pandemic. The reason that they actually want to do this during this refundable payroll tax credit is that it's going to be used so that help the employer pay the employer share of the Social Security payroll taxes for their employees. As you are aware, when you pay into Social Security, that's the payroll tax, you pay 7.65%, and your employer pays in 7.65%. So during this pandemic, they're giving them this credit up to $10,000 per employee to help them cover the cost of their share of the payroll taxes for their employees. This is my last slide, and so now I'm going to turn it over to Catherine Holland.